Turkey is profiting from the Iran-Israel conflict. Shipping reroutes through the Bosphorus, cargo flows through ports, tax breaks are luring trading companies. The money is flowing, but the clock is ticking on whether this bet actually pays off. I'm David, and here's what actually matters when everything comes down to timing. Recep Tayyip Erdogan leads a country that sits at every choke point in the Middle East. Turkey is a NATO member in a Muslim-majority region, and it borders Russia, Iran, Syria, and Iraq. It's the hinge between the Atlantic Alliance and the instability that erupts every time a superpower or regional power plays for territory or influence. Here's what that structural position actually means for his government. When the US wants leverage in the Middle East, it needs Turkish bases, Turkish ports, Turkish airspace. When Russia wants to check American moves, it works through Turkey. When shipping lanes in the Gulf get cut by conflict, oil prices spike, and cargo reroutes, Turkey becomes the toll booth. When Iran faces isolation, it still needs to trade with the wider world, and Turkey is the door. Erdogan's strategy is to profit from every one of these arrangements simultaneously. The catch, profiting from chaos, requires the chaos to stay at exactly the right temperature. Too cold and the rerouting stops, the premium dries up, and Turkey goes back to being a mid-sized economy with slow growth. Too hot and Turkey risks being dragged into a shooting war or facing refugee waves that overwhelm its borders. Erdogan has bet his recent years on threading that needle, staying balanced between everyone, extracting value from regional conflict without appearing to pick a side so hard that either the West or his own people force his hand. And right now, the balance is tightening. The Bosphorus Strait is a choke point. On one side is the Black Sea and Russia. On the other is the Mediterranean and the open ocean. Every tanker carrying oil or gas that doesn't want to risk the Iran-Israel corridor goes through this narrow channel, where Turkish coastline is visible from both sides. It's been a strategic crossing for centuries. But right now, it's become something else, a toll booth. When shipping in the Gulf gets disrupted, whether by conflict, drone strikes, or just the credible threat of them, the economics of rerouting suddenly flip. A tanker that would normally pass through a faster route now pays Turkish port fees, transit fees through the strait, insurance premiums that jump because any alternative route feels riskier. Shipping companies that want to guarantee cargo reaches buyers uninterrupted pay premium rates for Turkish infrastructure. This means Turkish ports operate above normal capacity. Bosphorus fees tick up. The government collects transit revenue. And here's what nobody talks about. When routes are contested, insurance becomes the third toll, and those premiums stay in Turkish banks. Erdogan has positioned Turkey as the safe exit from chaos. That positioning is now worth money, but shipping is only part of it. In June of 2026, just a month ago, the Turkish government passed new tax legislation aimed at one specific target: trading companies based in Istanbul and Mersin. The law offered near-complete tax deductibility for transit trade earnings. That's a massive incentive. It signals one thing clearly: Ankara views transit trade as an underexploited opportunity. Why push this now? Because Iran is isolated from the global economy. Western sanctions have cut off its direct trade routes, but Iran still needs to buy and sell goods. So those flows find an intermediary, a Turkish trading company that buys Iranian goods, re-exports them with the Made in Turkey label, or imports goods back to Iran and skims a fee. The government just made that arbitrage much more profitable. The infrastructure is shifting too. The August 2025 deal that resolved the Armenia-Azerbaijan conflict, unlocked the Middle Corridor, linking Central Asia and China directly to Turkish ports. There are plans for Iraqi oil pipelines to Ceyhan and a Qatar-Turkey gas line via Syria, all positioning Turkey as a central hub for cargo flowing across the region. The June tax cut wasn't a response to existing volume. It was a bet on what's about to happen. Turkey is building out to catch flows currently being choked off by conflict. And the same logic: buy low, sell high, collect the fee applies to energy too. Next month, Turkey's gas contract with Iran expires. 14% of Turkey's gas currently comes from Iran. In March, Israeli strikes destroyed Iranian gas fields, forcing Turkey to scramble for replacement supplies from Russia, Azerbaijan, and spot liquefied natural gas, all far more expensive than the contracted Iranian price. Now Turkey faces a choice: renew with Iran and risk US tariffs, find alternatives and pay higher prices, or activate a workaround it's been quietly building since March 2025. That workaround is called a gas swap. Here's how it works. Turkey allows Turkmenistan gas to flow through Turkish pipelines toward Iran. Iran earns transit fees without Turkey directly buying Iranian gas. On paper, Turkey isn't increasing reliance on Iran. In practice, Iran gets paid, Turkey keeps the gas flowing at a price it can afford, and Turkey gets to tell the US it's finding a middle path, not pure compliance, but not defiance either. The US has threatened Turkey with 25% tariffs, specifically over Iran trade. By July, when the contract expires, Erdogan will have to choose: face American tariffs, face a domestic energy crisis, or double down on the gas swap and hope the US accepts it as a workaround. Losing 14% of gas supply overnight would crater Turkey's economy. Every option costs money. The negotiation is already happening, and it's getting tense. The US has threatened Turkey with 25% tariffs on Turkish products, specifically because of Turkey's trade with Iran. This isn't hypothetical. Turkey already faces 15% tariffs on exports to the US, imposed in August 2025. The threat is explicit: keep buying Iranian gas, and that 25% lands on top. Ankara's response is not compliance. Turkey is negotiating. The core of Turkey's leverage is simple. Iranian gas is 14% of Turkey's supply. Turkey cannot afford to lose it overnight without crippling its economy. If the US wants Turkey to wind down Iranian imports, the US needs to offer something valuable enough to offset that loss. That's the negotiating position. Turkey is holding it. This isn't new. Turkey has already demonstrated it will resist Western pressure. Despite NATO pressure, Turkey refuses to adhere to sanctions on Russia. Turkish banks face intense scrutiny from US and EU authorities for allegedly helping Russian firms circumvent measures. The pattern is clear. When Ankara calculates that compliance costs more than resistance, it resists. Iran gas is worth real money. But here's what neither side is talking about. Even if Erdogan wins this negotiation and keeps Iranian gas flowing, Turkey's economy is fracturing in ways tariffs can't fix. The research projects Turkey's current account deficit will hit 1.7% of GDP in 2026. That doesn't sound dramatic until you translate it: nearly $20 billion. It's wider than the Turkish government forecasted, and it signals one thing clearly: the war dividend is much smaller than the rhetoric suggests. Why? Higher tariffs abroad, weak growth in Turkey's main export markets in Europe, unfavorable exchange rate movements. The lira weakened significantly through 2025. Prices for imported goods have risen. Households are paying more. Exporters are struggling. The rerouting gains additional revenue from Turkish ports. Transit trade, re-export fees haven't yet made up the difference. Analysts project meaningful economic uplift from new transit hubs and trade corridors won't materialize until 2028 or 2030. Turkey is building the infrastructure now. The payoff is years away. So right now, Turkey is in a squeeze. The economy is growing, but it's growing on borrowed time. The current account is widening. Export markets are soft. Tariff threats loom. And the structural changes that would actually fix these problems are 2 to 4 years out, which means the next 24 months are the most dangerous for Erdogan. Right now, Turkey is hosting about 2.5 million Syrian refugees. That number has stabilized. Erdogan has been pushing repatriation as a political win. But that calculation flips instantly if the Iran-Israel conflict widens. A deeper regional war would risk triggering massive new refugee waves from Iran, Iraq, and Syria. Turkey would be on the front lines of a refugee crisis that could add millions. Add a second time bomb next month, Turkey's gas contract with Iran expires. That window for negotiating an extension closes in 30 days. If Turkey and Iran don't reach a deal, the gas shuts off in July. If a wider conflict erupts, Iran's ability to negotiate vanishes. All leverage disappears. And then there's oil prices. Turkey's lira is exposed to oil shock inflation. If a wider conflict sends crude soaring, prices at the pump surge, and the central bank faces a choice: raise interest rates to fight inflation and strangle the economy, or hold rates steady and watch the currency crater. Refugees, energy contracts, oil shocks, they are not independent problems. They are interconnected. A crisis in one column topples the others. None of this is guaranteed, but it's all possible, and it reframes what Turkey's war dividend actually means. Turkey's war dividend is real. The Bosphorus is moving more cargo. Turkish ports are handling higher volumes and collecting transit fees. The government just passed tax incentives to attract re-export companies. Regional disruption is creating genuine economic activity in Istanbul and Mersin. The money is flowing, at least in micro-level transactions. But the bigger picture is unstable. The payoff Turkey is betting on where transit hubs, trade corridors, and new energy arrangements actually move the needle on GDP and current account deficits doesn't arrive until 2028 or 2030. That's 2 to 4 years away. Right now, Turkey is in the middle, collecting fees while the infrastructure is being built. It's profitable, but it's not enough to offset tariffs, weak export markets, and a widening current account deficit. Turkey is riding a wave, but the wave is carrying it forward on momentum alone. If the momentum stops, Turkey has nothing underneath. The equilibrium breaks 2 ways. If the shooting stops, if the Iran-Israel conflict de-escalates or ends abruptly, the rerouting stops. The premium vanishes, and Turkey's special status evaporates. Or if the conflict escalates beyond the current perimeter into a wider regional war, Turkey gets flooded with refugees, its energy security fractures, and the economic activity gets overwhelmed by crisis management. Either way, the window where Turkey profits from chaos closes. The bet only works if the conflict stays exactly as hot as it is now, for another 2 to 4 years. That's a fragile equilibrium. It holds only as long as nothing changes. Turkey's dividend is real but fragile. The payoff doesn't arrive until 2028. Until then, it's riding on borrowed time, betting the chaos holds. I'm David. Subscribe